Thanks for watching. If you like our channel, please subscribe now, then you will not miss any videos in the future. Ever wonder what makes a company a good investment? In the intricate world of finance, investment is a game of strategy, a balancing act of risk and reward. It's not simply about picking any company that catches your eye. Oh no, it's about identifying those unique businesses that have the potential to thrive and grow over time. But what factors make a company stand out in the bustling marketplace? There's financial performance, market position, and leadership, to name a few. However, one key element that savvy investors pay close attention to is a company's competitive advantage. This leads us to a fascinating concept, one that has been instrumental to the success of one of the world's most renowned investors. A concept that acts as a protective barrier, safeguarding a company's profitability and warding off competition. Enter the concept of economic moats, a term coined by the investment guru Warren Buffett. So what are these economic moats, you ask? Well, think of a company as a grand castle, and the competitive business landscape as a battlefield filled with rival kingdoms. The castle's moat is its first line of defense, protecting it from potential invaders. Similarly, in the business world, an economic moat refers to the sustainable competitive advantages that a company possesses, which enable it to maintain its profitability and fend off competition over the long term. This could be a strong brand that customers trust, a cost advantage that allows the company to offer competitive pricing, or even a network effect that increases the value of the company's product or service as more people use it. In essence, an economic moat is a unique strength that sets a company apart from its competitors. Buffett often looks for companies with strong economic moats, but what does that entail? Economic moats come in various forms. Let's delve into some of them. Firstly, we have the brand moat. This is the power of a company's brand name, its reputation, and the trust it has built with customers over time. Think Coca-Cola, Nike, and Apple. These are all companies with powerful brands that people around the world recognize and trust. Because of this, consumers are willing to pay a premium for their products, leading to higher margins and customer loyalty. Next up is the cost moat. This refers to a company's ability to produce goods or services at a lower cost than its competitors. This could be due to things like economies of scale, superior technology, or access to low-cost materials. Companies with a cost moat can maintain higher profitability or offer competitive pricing, making them a tough competitor to beat. Then there's the network effect moat. This happens when the value of a product or service increases as more people use it. Companies with strong network effects like Facebook, PayPal, and Amazon often dominate their markets because users find it hard to switch to competing platforms. Another type is the switching costs moat. This refers to the time, effort, and money it takes for a customer to switch from one product or service to another. Companies can create a switching cost moat by making it costly or inconvenient for customers to switch. Think Salesforce and Netflix. They've effectively locked in customers with their unique offerings and subscription-based services. We also have the regulatory moat. Some industries have heavy regulations that create barriers for new competitors. Companies that can navigate these regulatory hurdles and comply with industry standards, like pharmaceutical or energy companies, often have a competitive edge. Lastly, we have the intangible assets moat. This includes things like patents, copyrights, trademarks, and proprietary technology. Companies with valuable intangible assets, like Google or Microsoft, can protect their intellectual property and prevent competitors from replicating their products or services, giving them a significant advantage. These are just a few types of economic moats that Buffett considers before investing. But why are these moats so important, you may wonder? Well, let's dive into that. Economic moats, in essence, are a company's shield and sword. They are strategic fortifications that protect a company's profitability and market share from competitors' onslaughts. Just like a castle's moat deters potential invaders, a company's economic moat discourages competitors from breaching its market dominance. But it's not just about defense. Moats also play a critical role in a company's offensive strategy. They empower companies to venture into new markets, launch innovative products, and take calculated risks, all while safeguarding their bottom line. Imagine for a moment a company without an economic moat. It's vulnerable, exposed to the harsh winds of market competition. Any new entrant with a competitive offering can swoop in and steal its market share. In contrast, a company with a robust economic moat can fend off such threats, maintaining its profitability and market dominance. The importance of economic moats extends beyond just the company. They are also vital for investors. When Warren Buffett considers an investment, he looks for companies with wide economic moats. Why? Because these companies are more likely to withstand market fluctuations and disruptive forces. They have the resilience to navigate through economic downturns and the strength to capitalize on market opportunities. Moreover, companies with economic moats are more likely to create value for shareholders over the long term. Their sustainable competitive advantages enable them to generate steady profits, which can be returned to shareholders through dividends or reinvested back into the business for future growth. And it's not just about financial returns. Investing in companies with strong economic moats can also contribute to more stable and predictable investment portfolios. These companies' resilience and market dominance can help mitigate investment risk and provide a buffer against market volatility. So the next time you ponder about an investment, remember to check for the company's economic moat. It's not just about what the company does today, but how well it's fortified for the battles of tomorrow. To sum it up, economic moats are the sustainable competitive advantages that companies use to fend off rivals and maintain profitability over the long term. They come in many forms, from the brand recognition of companies like Apple and Nike to the cost advantages that allow certain businesses to maintain higher profitability. The network effect, seen in companies like Facebook and Amazon, increases the value of a product the more people use it. Then we have the switching costs that lock customers in and regulatory barriers that keep competitors out. Lastly, there are intangible assets like patents and copyrights that protect a company's unique offerings. Warren Buffett's investment strategy is heavily focused on identifying these moats, as they signify a company's ability to withstand competition and generate long-term profits. So, as we navigate the world of investments, let's take a leaf out of Buffett's book. Remember, investing is not just about the numbers, it's also about the moats.